like to welcome you to a short presentation on Engro Corporation's half-yearly results. And in the next few minutes, I'll talk you through key highlights. I'll cover Engro Corporation from a standalone as well as a consolidated results perspective. The corporation operated in an environment where the economy experienced about 6% annualized growth, and for the first half of 2018 saw significant forex volatility. However, given the structure of Engro's businesses, the corporation remains naturally hedged against rupee depreciation. On a consolidated basis, the revenue of the corporation grew by 37%. This was primarily due to outperformance in our two main businesses, fertilizers and polymer, where higher volumes and prices were seen in urea as well as PVC. Turning to profitability, on a standalone basis, the variance in profit was driven by a super dividend received from Engro Foods last year. Consistent with last year, the corporation declared a dividend of 12 rupees per share for the first half of the year. Now turning to performance per business. For Engro Fertilizer, the 74% bottom line growth was largely due to higher sales volumes and prices, coupled with lower financial charges. For this industry, the disbursement of subsidy remains a major area of concern, and Engro continues to engage with the government to resolve this. Volume is expected to remain robust for the remaining part of 2018. The polymer business had a good half year and achieved highest ever production, which was enabled by a successful debottlenecking project, resulting in half-year profit after tax of 2.7 billion rupees. Margins remained robust and market dynamics appear to be steady for the time being. The previously announced rights issue for PVC and VCM expansion projects has been fully subscribed, and the company is on track with other milestones for this project. Within the energy business, our operating entity, Engro Powergen Kadirpur, performed better than last year as a result of sustained plant availability and cost measures. We foresee circular debt to remain a challenge for the energy sector, and we remain engaged with government to seek solutions. The terminals business continues to provide steady cash flows, although the Vopak joint venture faced a volume drop relating to LPG. Engro Corporation recently signed an SPA with Royal Vopak for the divestment of a minority share in Engro's LNG terminal. That agreement is subject to statutory and regulatory approvals. Engro views this as an important extension to an existing strategic relationship with Royal Vopak. Now looking at our significant under construction projects. On the 10th of June, our coal mining venture successfully reached the first seam of coal at a depth of 141 meters in line with the project plan. The related power plants at the mine mouth successfully received back feed from the national grid, which is a significant project milestone. The project is expected to commence commercial operations by the middle of 2019. The balance sheet continues to show a prudent level of gearing of less than 40%. As a result of steady cash generation and expected future cash flows, the credit rating of Engro Corporation has improved by one notch to AA+. Similar upgrades have been achieved in some of our portfolio companies as well. Finally, a word on future strategy. Our portfolio growth remains directed to these four pillars. Work continues in the agri-solution space, which include an extensive pilot project focused on providing various agricultural inputs under one roof. In energy infrastructure, we continue to grow our footprint by participation in other mine mouth power projects such as Siddique Sons. We are also evaluating participation in transmission. Our logistics pilot with IFC is progressing well. And finally, using our polymer platform, we will continue to invest in opportunities in allied chemicals. I thank you for your attention and look forward to providing you with further updates periodically.